interest rates continuing to ease and transmission getting even better. Last and not the least, where is the rupee headed? We believe that given the global dynamics, our own estimation is in the near term, rupee could be at 66 levels, 66, 67 levels. Around the time when Fed hikes around December is our base case scenario, we expect rupee around 67, 68 levels. The reason we are not looking at above 68 levels is because our real effective exchange rate, if we track that, adjusted to inflation, the exchange rate with our trading partners, and if you look at the recent readjusted currency levels, it boils down to just 4 or 5% of overvaluation of our currency. When we say overvaluation, that means rupee needs to get weaker, and we believe that there's not significant amount of room for rupee to weaken, maybe just to about 68 levels. Also, the reason why is RBI has built its chest of forex reserves. Of course, it has depleted in last 2 or 3 weeks by about 6 odd billion. It's slipped now below 350 billion, but that's exactly what the reserves are for. On all our reserve indicators, adequacy of forex reserves, India is doing pretty good. And, at these times, Reserve Bank of India will be, looking at containing the runaway speculative element, perhaps if that ever creeps in. To our mind, not. India is in a far better position. 2013 was a perfect storm. Everything that needed to go wrong had gone wrong. In 2015, India has very sound fundamentals. India has political stability, and that's a great positive combination. When risk appetite returns to the global economy, in the global markets, I think India will bounce back. And it's not just the portfolio flows that I'm talking about, but I'm talking about the foreign direct investment, which will be the key pillar for capital flows to come into India. And I would think that India definitely is poised to get to its potential growth, concentrate on the domestic drivers, policies, frameworks, sustainability, and India has got a perfect recipe to replace China. Thank you.
Thank you, Dr. Rao. I think she has set the tone for a very good day today, and absolute positive outlook that you have presented. I am of the same opinion. We know that right now people have different views. Many people feel that government could have done more. But I think I totally agree with what she has said. And China's problems is an opportunity. Definitely. I feel that is the opportunity. And the time for India has also arrived. I mean, how long India can just sit back? I mean, you look around the world, the US, Europe, your neighbor China, and then that's it. So that is the time. So I think all the heads of banks who are sitting here, they have to take it on from here on a positive note. And I'm quite sure 7.8 or 8, it won't be much different. But if we are achieving even 7.8, when everybody else, what they are, I think it's a great number. And the changes don't happen in a year or two. Country is too big for change to happen in a year. I think she also said about have some patience. So I think we all have to work with that. And future is bright, and therefore the bank and the banking colloquium on broadening the horizon and the topics that are coming up will be a very positive discussion from here on. Thank you very much for your very passionate address. We now have Mr. G. Gopalakrishnan, the Director of Center for Advanced Financial Research and Learning. He will be talking on the regulatory changes on business environment. Thank you.
Admiral A.K. Verma, Sri C.S. Ghosh, distinguished speakers on the dais, MDs, CEOs, and executive directors from commercial banks, and senior executives from banks, ladies and gentlemen. I'm first of all thankful to the CII for giving me this opportunity to be here as part of your colloquium today. I would also join all of you in complimenting Mr. Ghosh for setting up the first bank in the eastern India after independence. Although I've been given 15 minutes time, I'll ensure that I'll cut down so that I will not overshot this session since I have a written speech. I would like to start with a thanks to CII for inviting me for this banking colloquium. I will confine my discussion today in three or four topics, namely banking and real sector, competition from the payment banks and small banks, a digital disruption, not elaborate as you have a separate session, pricing of loans in the context of revised draft-based guidelines issued by the Reserve Bank of India. It's a common knowledge for all of us that the banking sector reflects the real economy, and that is the state of affairs today. As we are a bank-dominated financial system, our reliance on banking system is much more than other countries, and hence financial stability is a paramount importance for the country. Bank regulation is intended to reduce probability of bank failures and ensuring financial stability. Capital regulation has emerged as a central pillar of global regulation framework for the entire world. A well-capitalized banking system is resilient to shocks and is able to provide credit to real economy in a sustainable manner. We have seen after the global financial crisis, regulators worldwide are constantly thinking about modalities for making banking system safe and sound for their efforts, and are fully supported by the international bodies like the BIS, the Financial Stability Board, the G20, and so on and so forth. Basel III capital regulation is being implemented in India, as speakers referred to, in a phased manner from 1st April 2013, and it will be fully implemented by 31st March 2019. The capital to risk weighted asset ratio of scheduled commercial bank was 12.9% in March 2015. The position of course, public sector banks is much lower than this. It is also a cause of concern that the capital position of our banking system today is one of the lowest compared to with the other emerging economies as well as developed economies. This leads us to the conclusion that capital levels of our banking system has to go up significantly if our banks have to compete with globally and also lend to the economy. This will require capital infusion through higher earnings and also capital raising from the market. This issue is more relevant to the public sector banks than private sector banks. Due to high levels of stressed asset of the public sector banks, their capital has been depleted significantly. If the public sector banks have to grow at 20% in the current financial year for meeting a GDP growth of 7.8%, they have to improve their capital position quite significantly in the current year. Of course, the government has recently announced 70,000 crore capital infusion over a period of next 4 years. The public sector banks will get 25,000 crore in the current year and another similar amount in the next fiscal year, as well as another 10,000 crore in the next 2 years by 2019, when the new Basel norms kick in fully, which require banks to have a higher capital to take care of market risk besides the other risks. Besides, the public sector banks also have to raise huge capital by way of increased retention as well as by other form of capital. This capital infusion will ensure that the public sector banks are also able to support the growth which we badly need. Basel III regulations are not likely to impact lending to any specific sector, including that of infrastructure financing by the banks in a negative manner. Today, banks are flush with funds, but there are no demand and not many good projects or proposals are coming before the banks. At the same time, of course, as we start implementing the advanced approaches and fully kick in the Basel III norms, lending to corporates will become an issue because banks will be able to lend only to highly rated entities in the days to come to meet the compliance with the Basel III and Basel II requirement. Of course, there would be an issue of exposure norms under Basel framework, which the RBI has already issued the draft guidelines, under which individual exposure as well as the group exposure is capped at 25% of the Tier 1 of capital against the current liberal norm of almost 55% if it is an infrastructure project. So this is going to be a big challenge for not only for the banks, but also for the corporates. But the only thing is banks as well as corporates have another 3 to 4 years to meet this compliance. Yeah. In the meanwhile, corporate borrowings, companies are also need to move fast and find out means to supplement the borrowings from the bank with capital market borrowing or issue of corporate bonds. RBI and government have already been making efforts towards developing a robust corporate bond market, and proposed rate enhancement by the banks of corporate bonds could act as a catalyst. Corporates also have to look at their leverage, as many of the corporates have assumed huge amount of debt vis-a-vis equity. And today, the stress in banking is more due to the stress in the real economy, which has been passed on to the banking system. This is a fact that the main cause of present state asset scenario in the banking today. When corporates have to tap corporate bond market, there is bound to be much more credit discipline, since unlike credit in the case of bonds, even a single day delay in servicing the debt would be treated as default. My second summation is about competition of small banks, payment banks, and tap and bank on tap license. The banking sector will experience a substantial change in the nature of competition, as two of the new universal banks, Bandhan Bank, IDFC, starts operation, and a number of payment banks and small bank finance as approved recently by the Reserve Bank of India. Payment banks in India, apart from reducing the cost of remittance, the setting up of payment banks will also be aid further to financial inclusion. The payment banks are also likely to increase the financial savings of the small customers, as they provide small savings account and payments, remittances service to migrant labor, workforce, low-income households, small business, other unorganized sector entities, and other users. As the maximum deposit which can be taken by the payment banks has been limited to rupees 1 lakh, the account will be fully secured by way of deposit insurance. There is, however, an issue of payment banks are not allowed to lend but invest the deposit proceeds in the government securities. Payment banks are expected to offer bank account in every corner of the country, facilitating payment and cash transfers through the new technologies and physical access points. RBI has also announced issue of 10 licenses to small and small finance banks. Another new set of differentiated bank, as all of us are known. The objective of setting up small finance bank, like the payment banks, is also furthering the financial inclusion. The small finance banks shall primarily undertake basic banking activities of acceptance of deposit and lending to undeserved section, including small business units, small and marginal farmers, micro and small industries, unorganized sector, and so on and so forth. It can also be undertaken other non-risk sharing simple transactions, like requiring non-commitment of capital, like distribution of mutual funds, insurance products, pension products, etc. All these developments are likely to bring in a new era of competition in banking and also aid much needed financial inclusion. But this competition is also may pose a challenge to the existing banks, as these new banks are likely to attract skilled personnel from well-established public sector banks as well as the other banks. My third submission will be on the digital disruption. The recently launched Prime Minister's Digital India Initiative aims at integrating the government and related departments and the public, and the objective of making public service available to citizens electronically. The Digital India Initiative aims at creating a nationwide digital infrastructure, both broadband and high-speed internet, delivery of government services digitally, and also increasing the digital literacy. This would provide opportunities for banks to innovate and expand services to reach the vast majority of the rural population through electronic deliverables. As discussed in the January 2015 banking conclave, Gyan Sangam in Pune, the top 30 processes in public sector bank account for almost 50% of the cost in the back office and over 80% of the customer-facing activities. If banks can take steps to digitize the top 30 processes quickly to improve customer experience and cut cost, they can reap huge efficiency and profitability gains. Many banks, big as well as small banks, both in public and private sector banks, have started in a big way the digitization of most of the transaction. But if other banks are not doing it in the next 2 years, the new payment banks, the e-commerce companies, retail payment players will pose a big threat to the banking and these banks have to move fast for their survival. This will also help banks to provide payment gateways to e-commerce, help in smooth implementation of GST, and servicing the PMJDY accounts, and so on and so forth. My last submission will be on the pricing of loans in the context of revised draft base rate guidelines issued by Reserve Bank of India. Recently, a CRISIL report noted that the profitability of the banks could take a one-time impact of around 20,000 crore in 2017, that is 16-17, once the new base rate computation is implemented. And again, according to ICRA, banks might income loss up to 22,000 crore due to a 75 basis point drop in the interest rate if they use marginal cost methodology to fix base rate. This means that change in base rate computation would be a positive for the borrowers, of course, at the cost of banks in the interest rate and declining scenario. Thank you for this opportunity.
Thank you, Mr. Gopalakrishnan. There is no doubt digitization is the way forward, and it has to happen. It will happen in the banking sector. We all know that everything is going to be on mobile in future. So, and any digitization always reduces the cost of operation. So that should be, thank you very much for your address. Yeah. So, ladies and gentlemen, we come to the end of the inaugural session. May I now request Mr. Vijay Maheshwari to propose the vote of thanks.
Good morning to all of you. Dignitaries on dais, dignitaries of the banking sector, friends, ladies and gentlemen, a very good morning to all once again. It's my privilege to deliver the formal concluding remarks at this inaugural session of Banking Colloquium 2015. I would like to start congratulating Mr. C.S. Ghosh first, and for Bandhan Bank journey from microfinance institution to a bank. He was always a very active member of CII Banking Corp Group, and it gives us immense pleasure to have him as the MD of the new bank as well as the chairman of the subcommittee. The journey has been truly remarkable one. With IDFC Bank also set to start its operation in October this year, we wish to see both the bank reach greater heights in future to come, and also have a healthy competition between both of you. It has been delightful to hear from Dr. Rao, Chief Economist Yes Bank, about the ways of reviving the economy and the interplay of regulatory changes on business environment. Thank you, Madam. Mr. G. Gopalakrishnan, Director, Center for Advanced Financial Research and Learning, has lucidly explained us how the regulatory changes are going to impact the economy at large and thereby the industry. He also stressed on a payment bank and small banks, how they are going to make cost competitive structure. Also, the presidency report of building customer-centric base by Deloitte, Ms. Abhijit of Deloitte has set the tone of the day. India's service sector has always served the country's economy well, accounting for about 57% of the gross domestic product. Economy Ministry of External Affairs, Investment and Technology, Promotion Division. In this regard, the financial service sector has been an important contributor. The size of banking assets in India is USD 1.8 trillion in year 14 and expected to touch USD 20.5 trillion by year 25. The macroeconomic prospects for the Indian economy have also improved considerably in the last few months. GDP is estimated to inch around 7.8% in 2016. There are a number of factors that can be contributed to the initial signs of recovery in the economy. Global crude oil remains low. Demand also remains low for the crude oil, thus helping to partially offset the major stress point in the economy, mainly to inflation and twin deficit. To top it, multi-dimensional reform agenda initiated by the government has also regenerated the feel-good factor, which in turn has raised the business prospects of the economy. Looking forward, the Digital India launch took off with a promise of rupees 1.5 trillion investment and 1.5 million jobs. This is a time for new initiatives, new mindset, new thinking, new process, and new partnership. India's growth in the years ahead will be dependent on the rate of which we transform digitally. Both the government as well as the industry will have to play a key role in transformation process, as the nature of the technology is disruptive and high level innovation is required to path ahead. The rising consumerism from the emerging middleman, younger generation, and the higher purchasing power in rural India on account of rising employment provides opportunity for banks to look beyond the traditional customer segment. Further, over the last few years, the use of technology has been extensive in the Indian banking scenario. It has been largely helpful in implementation of financial inclusion and which reaches unbanked people at large. Unbanked people in the country. There has been a sea change in the way Indians transact, with the digital transaction rising sharply, M-wallets, prepaid cards, M-banking, payment banking, e-commerce are all gaining popularity. Payment banks are here to expand the space to bring these benefits to low-income consumers. The Colloquium is happening at a crucial junction at only on 16th September. The Reserve Bank of India granted small bank license to 10 banks. Hopefully, this should bring the cost down for the customers at large. And most of these 10 banks which have given licenses are microfinance companies which have enough learning to transform the learning in the banking segment. At this junction, 8th edition of CII Banking Conclave will deliberate on the opportunity of the latest development and brainstorm the solution of the challenges involving the stakeholders in this forum. I am thankful to the leaders of banking financial sector for accepting our invitation and share their expert views with industry members. The dialogue session is going to be very interesting, with the financial sector visionaries sharing their perspective on the major changes and their impact. I would like to thank our partners, principal partners, Bandhan, Reliance, Union Bank of India, State Bank of Bikaner and Jaipur, technology partner Cisco, gold partner Bank of Maharashtra, silver partner Bank of Baroda, Resurgent India, State Bank of India, SBI Capital Market, and UCO Bank, and corporate partners INCAM, United Bank of India. And thank you for coming, and thank you very much once again. Bye. Thank you.
Now may we request our chairman, Rear Admiral Verma, to present the mementos to our distinguished guests and speakers. Mr. Gopala Krishna, Director Capital. Mr. C.S. Ghosh, MD and CEO Bandhan. Dr. Shubhada Rao, Chief Economist, Yes Bank. Mr. Abhijit Bandyopadhyay, Partner, Deloitte. Thank you, sir. We will just take a 5 minutes break for the session changeover. We will immediately start our very interesting session, the CMD's Roundtable on Evolving Strategies. Srinivas, Managing Director and CEO, United Bank of India. Mr. S.B. Nair, Chairman and Managing Director, IIFCL. Mr. Ranjan Dhawan, Managing Director and CEO, Bank of Baroda. Mr. K.V. Srinivasan, CEO, Reliance Commercial Finance. And may I invite our moderator of the day, Ms. Nisha Poddar, Anchor and Editor, ET Now, on the dais, please. Thank you.
Nisha Podar from 18R. Hi, nice to meet you. Come, Mr. Ghosh.
May I request the delegates to take your seat, please? And I would request Nisha to moderate her session. Thank you.
Thanks, Abhishekta, for that. Can we please be seated and can we please start the session? I will require your cooperation for that, please. We would like to start in 10 seconds from now, please. Thank you so much, ladies and gentlemen. Hello and a warm welcome to one and all. And this is the CMD's roundtable at CII's Banking Colloquium, and ET Now is media partner for that, and I am Nisha Podar. As many experts in the sector put it, the financial services sector in India is at the cusp of a paradigm shift. No doubt, things are changing. Groundwork is being done right now so that it materializes in a few years from now. I'm glad that we have a panel of luminaries with us today who will throw more light on where the banking system is going and what are the evolving strategies. Let me start by introducing our panelists here, starting with Mr. C.S. Ghosh, the Managing Director and CEO of Bandhan Bank with us, Mr. Rajneesh Kumar, who's the Managing Director of State Bank of India, Mr. P. Srinivas, the Managing Director and CEO of United Bank of India, Mr. S.B. Nair, who's the Chairman and Managing Director of India Infrastructure Finance Company Limited, Mr. Ranjan Dhawan, who's the Managing Director and CEO of Bank of Baroda, and also we have with us Mr. K.V. Srinivasan, the CEO of Reliance Commercial Finance. Thanks so much, gentlemen, for joining us today. And I will try my level best to draw on your expertise in this sector. Now, it's only right to say and start by talking about the global developments. And I'm sure on the night and the midnight of 17th of September, a lot of us in this room have waited up till midnight and watched what the Fed had to do. Of course, it was a status quo from US Federal Reserve, but then a very important takeaway from what Janet Yellen said post the policy is that US Fed is keeping a very close eye on the global economics and the financial developments. And this, in a way, also reiterates what RBI's Governor, Dr. Rajan, has been saying for quite some time about the gradual coupling of all the economies in the world and how the global risk factors are much more than ever before. We saw how China devalued yuan and the entire global market went into a tizzy. I'll throw my first question to Mr. Rajneesh Kumar on the global risk management in India. Of course, Mr. Kumar, we are progressing towards Basel III, but then are we well equipped to deal with these global factors? We saw China devalue its currency. Are we well equipped if other currencies or other countries also throw up such concerns for us?
Right. I think your question is very, very valid and relevant today. But you have mixed up two things. One is definitely about Basel III. And what is happening in the Indian banking system is that risk management has been equated with Basel III. Because what has happened over a period of time, that in India, the liberalization as we see it started in 1992, globalization of Indian economy. And before that, there was no formal risk management system in the banks, and everything was left to Reserve Bank of India, including, I remember the times when we wanted to give a loan above rupees 1 crore, and we used to go to Reserve Bank of India under credit authorization scheme. Interest rates were all fixed and administered. There was no requirement for managing liquidity risk because everything was being done by Reserve Bank of India. So in last 23 years, we have come a long way. And 2008 global financial crisis, that was the watershed year. Prior to that, 2000, this one, 9/11, that was another watershed year. So in the banking system, when we look at risk from macro perspective, that is what you have mentioned, that there is a demand suppression globally. There is a crisis brewing in China where their growth has come down. And because of their growth having come down, the commodity prices have come down, oil prices have come down. So in a way, in India, it is very good because your now current account deficit has come down to a very, very manageable level. And India was always importer of energy. And now with the prices coming down, at a macroeconomic level, we are seeing a much better environment. But individually for the banks, as far as risk management practices are concerned, these are still in evolutionary stages and lot of work is going on. It is a work in progress and there are many things which need to be done. But again, like if you see the global risk management and Indian risk management, there is a key difference. From 2008 till today, global banks, and you name anyone, whether it is Bank of America, JP Morgan, or any big names and they have cumulatively paid $235 billion in fines, which is equal to the GDP of Greece or Portugal. And what are the items they have paid fine? They have paid fines for mis-selling of insurances. They have paid fines for violation of KYC and AML guidelines. They have paid fines for doing transactions which they should not be doing, and they have paid fines for manipulating interest rates and forex markets. So these are some of the, and none of this has to do anything with the Basel requirement on capital adequacy framework or this thing. And we are aware that in many, many cases, one single trader, they have been able to bring down the whole bank, Bearings being the first example which immediately comes to the mind. So when we talk of risk management, and earlier speakers in earlier session from Deloitte, there was a lot of talk about improving the credit risk management practices. Mr. Gopal Krishnan covered a couple of issues on Basel III and this thing. But apart from what is required under Basel, I think banks need to have a very strong framework to manage the kind of risks which I am mentioning to. Apart from when you deploy technology, it brings its own risk in terms of your cyber crimes, your information security, how robust your systems are. So I think apart from Basel III, what needs to be focused on is the corporate governance structure, attitude, and the culture. In all these banks which I gave the example, they may be having, and we feel that they have a very strong risk management architecture, but ultimately it is the attitude of the management, and if that attitude, how does it percolate down the line? Unless that happens, you may put any system, but it will not work. And that is the key message which I would like to give today.
Right. That's a very pertinent point that has been mentioned. Mr. Srinivas, you would like to add to that? Are we well equipped? And of course, the currency risk factor as well.
Mr. Rajneesh has well covered what are the risks in global level it's happening. In a way, the risk management conceptually it is changing over a period. And the impact of the global, we are, for the last few years, slowly if you see, we are getting more and more connected with the international world, banking activity or financing activity. The more you connected, you have more risk because you have the impact of the happening somewhere a nook corner of a Greece, though you don't have any kind of great business with Greece, still as a country, as a financial system, you have a problem. So the more and more we are getting connected, we should be much more strong, we should be much more understandable of the risk perception. And accordingly, we should have to make some additional activities. And something like a China, what happened, it automatically impacts us. There will be currency wars because the global risk has got, you have a currency risk, you have a country risk, you have an operational risk, and above all, you have a reputation risk also. So these are all the additional things. When you do more of a business internationally and global line, you have to look into it.
That's right. And let me get in one more bank on this. Mr. Dhawan, how are we seeing this particular situation and how do you think the banks are coping with this changing environment?
Let me first answer your currency risk. Currency risk at this time has been very well managed in the country. Whenever in the past we have seen the currency floating around at a particular level for quite some time. Suddenly there is a spike. We saw it in 2013. The rupee went up to 68. We are seeing in recent times that the currency has been very well managed. It normally is operating, we have noticed, in a band of about 50 paisa, and it is systematically floating down. I think one of the previous speakers has mentioned that at the present, at best, the rupee is overvalued by 3 to 4%. Therefore, the downside to the currency is not very much. I do feel that the currency risk is taken care of by a host of factors which have occurred. Number one, of course, is the current account deficit, which is well below 1%. I don't feel the currency impact will be there. The fiscal deficit also is under control. The oil prices particularly having moderated, I feel that currency risk in the economy does not remain. Rather, there may be a good upside that people do expect a lot of foreign investment to come in. So given capital inflows, I believe that currency risk is well managed. Having said that, it is always good for all corporates to hedge currencies. I do believe it. I have seen now corporate behavior, corporate best practices all over the world, and I do believe that a good corporate should not be taking calls on which way the currency would move. It is better to have narrower margins. I have seen corporate after corporate, their profitability wiped out, their earnings for 20 years, 30 years wiped out because they did not hedge their exposures. Please don't do it. And my best advice to corporates is not to guess on which way the currency will go.
Right. And Mr. Nair, you want to add to this in this fast-changing environment. Does the resources also pose a constraint for the banking and financial services sector?
Before I reply to that, I would like to add to what Mr. Dhawan has said. One of the reasons which I do a lot of project financing, one of the main reasons why corporates in India are avoiding hedging or underplaying the hedging is not because they are aware of the currency risk, but somehow they want to implement the project. They don't have enough capital, and they know that when you hedge it, the capital cost goes up. So they don't want to bring the additional 35% for that. So deliberately they avoid this. I've seen this again and again, and then after 3-4 years, they come and say that there's a cost overrun, please finance us. Now, internationally, like Mr. Dhawan said, these are not allowed at all in project financing particularly. You don't get the loan unless you hedge it. The second question you asked me about is the resources. I don't think resources is a major constraint as of now. If you look at the deposit percentage growth, for the first time in the last 3 years, the percentage growth of deposit has come down. As the economy develops, as India gets globalized and the global economy becomes, on par with other economies, definitely resource will be an issue because, if you look at any developed economy, all the savings don't come into the banking system. It goes into other sectors. There are far more sophisticated products will come. And if you look at many of the developed economies, they rely on wholesale deposit rather than retail deposits. But I think we are quite far from there. We have enough deposit. Right now, I think the problem is not enough credit offtake.
I'd like to add to that.
Sure.
Look, every bank is running 4 to 6%. Some are running 8% of excess SLR. There's plenty of money. There is no shortage of money in the banking system. The problem is a good, so resources are not likely to be a problem for a long time to come. I don't think anybody should be worried about it.
So let me come to the new kid on the block. Mr. Ghosh, what are the learnings that you're going to start off with as you start the Universal Bank? And also, how much role will the new technology and digital space have in this sphere?
Thank you. So we started not yet crossed that 1 month. We have got a very good response from the customer level. We expected, we like to give this, that expected 1 lakh or maybe maximum 1,50,000 customer will be like to come in a beginning day, on the 23rd August, but very fortunate is there that is come 5,50,000 in a day, 23rd August. So this is in big things. We see that the people are very much excited to come to the Bandhan Bank. Second point is there that is a little bit also is a problem for us because we are prepared ourselves with a 2 lakhs and coming to the 6 lakhs in a 1 day. So manage on this 6 lakhs it is now has come this. But within this month I have been like to complete it on that to get this total things on that. So as a bank journey of the less than 1 month, very good. And we are, there is in some of the area which we like to give the more focus on that in a bank because interior rural when we like to go to the work on that, the connectivity is not that much good. So that is when connectivity is not good, the customer will come to the bank branch, they will not get the service. This is in one area which is like to further build up the infrastructure, connectivity infrastructure in the rural India to develop in the banking services to the people. So this is one. And you know that this is now the time of the digital India. To digital India, any bank, they are focusing on that, how they can be used the digital to serve the people. And I also not behind this, but I also trying on that as a new bank to give these services, how we can be used the digitization. You know that we have the 2 different vertical working on that. One vertical, we said the general banking, out of that 510 branches we are serving as the same as the other traditional bank, they will be get the service. And they also get the service as a internet banking, mobile banking, that is also in a, now in the process on that. Within a next week, they will be get that services on that. But other part, we called the micro banking, that micro banking, those are customer level in the rural India, those are literacy rate is very low. They cannot fill up the bank deposit slip. They cannot withdraw the money with the check because they cannot write the check. And their signature is in every time have been changed on that. So how we can serve them? So we have been used the digitization to build up the POS machine. That POS machine, we have been also distribute the RuPay card to them, and they use the RuPay card, and biometric is the authentication. Through the biometric, immediately their accounts have been opened, and they can be deposit the money and withdraw the money, and they can get the slip, and that slip will be treated as a authentication of the customer. So in this way, we are using this technology platform to serve these people without fill-upping the deposit slip and check, all that. So we are using on that.
Oh, great. You so vividly put across the practical problem and how digitization and the technology can really help it. But let me come to our another speaker, Mr. Srinivasan. Talk to us more about the digital sphere. Of course, analytics, decision-making, averting risk in future, fraud management, all of this is getting addressed by the digital space, and not to mention the payments bank, which is now going to come up.
I think it's a matter of time before banking doesn't remain banking anymore, and it's certainly a matter of time that non-banks will do more banking than probably banks. So the distinction between e-commerce, telecom, banking, it's all disappearing in a very rapid pace. So obviously, the entire thing has to ride on technology and analytics to a very, very large extent. And not only obviously from the perspective of trying to seek out more customers and expand the market per se, but also from the perspective of risk management, fraud control, and so on. But the whole point is that the amount of forward-looking investment that one can do and one should be doing in analytics and digital delivery of that analytics is something which is very critical. Now, especially if you are not a bank, like we are a non-banking finance company, and we fund a lot of small and medium businesses who probably don't even keep proper accounts. Now, how do you actually address the risks which are associated with that? So, a huge amount of past behavioral analytics, cash flow kind of analysis, even some cases the social media interactions that they tend to have, because more and more SMEs are now getting connected into Facebook and Twitter and so on and so forth. So a lot of that, which is basically non-financial behaviors, give you a very strong indication in terms of what his credit behavior could be. And this can only come because of analytics. And as far as digital delivery of the same thing is concerned, obviously, when you have a salesperson going and interviewing a customer, either for risk management or collection related purposes, or even for opening a new account and new relationship, if you are able to equip that person through digital means of delivery, what your analysis of this prospective customer is, he could actually do a sale or a collection job in a much more efficient and effective manner. I think over a period of time, the importance of banking branches would diminish significantly, and I think it will diminish much faster than what we give credit for. If frankly speaking, if you can sit in your drawing room and you can scan your own retina, and through the digital means, the authentication is obtained from the UIDAI, and that reaches the bank, you really don't require anything else at all. And all the data that is there in UIDAI is pre-populated in your banking system. There is really no need for a form and a KYC and those kind of things. It's all there.
Right.
So it's a completely different way of doing things.
Mr. Srinivas, you agree with that bank branches would be obsolete in some time? Also, the cost of acquisition of client bit as far as digital space is concerned?
It may be correct to some extent in some part of the country, because still somebody like a Bandhan Bank and even a public sector banks like us who have a large number of rural sector branches, whereas Mr. Ghosh just now pointed out, still a basic connectivity is being an issue. You are not many of your handheld devices or your branches, they don't have a basic connectivity as we expect in the entire part of the country. So the infrastructure is to first to follow. Once infrastructure goes to the interior areas, and once people start using this digitalization in full expect, then over a period it may happen. But in urban and metropolitan, do agree that things are changing very fast, much as once everybody is having a smartphone nowadays, and which has got capability to do much of the banking activities. So this part of the world, there is going to be change. But ultimately, unless the infrastructure puts on, you will have a great gap between developed areas of the country and still undeveloped interior areas. That should be avoided to the possible.
No, I would like to make a rejoinder here. We are talking about digital India. I think digital change or digital India, if it comes about, it is going to be highly disruptive for the banking system as it is today. I personally feel, what happened in the mobile technology and all that, where the leading players suddenly overnight became, disappeared or went down in ranking. Something similar can happen to the banking system of the existing players particularly, before you know it's happening. Because digital revolution always have a way of disrupting things before you know it is happening. You are very comfortable in your current environment and suddenly you find you are no longer there. What happens is that I think more than banks like Bandhan, it is the payment banks which is going to affect the existing players, because they will have an impact on your CASA, and CASA is extremely critical for the profitability, particularly if RBI moves into the new way of incremental way of calculating base rates. CASA is extremely important. And I think these payment banks are going to disrupt this, because they can have, they can extend this reach even in areas where there is no infrastructure very, very fast. So I think we need to be very, very aware of that, and we need to be aware how the existing players are preparing themselves for this change.
Mr. Dhawan, I know you have something to add on that, but I have one question before that. He mentioned that Payments Bank, and of course competition is just increasing for the existing banks. But Payments Bank will have just 1 lakh of deposit. Is that big enough to move the needle for the existing banking industry?
No, I think payment banks will capture hitherto uncaptured segments. The public sector banks have already moved into this field. Even a bank like, let's say, Bank of Baroda has opened something like 10 million accounts. I'm sure that the payment banks will capture some part of that, and welcome. It is welcome. I think what the payments bank will do is deepen and broaden the market.
Increase
and
the pie.
They would. And I think, and they would provide a lower cost model, which a public sector bank may, because the public sector banks are geared up to do over a period of time, they have been geared up to do a separate sort of banking. For example, Bank of Baroda is basically a corporate bank. So therefore, I think the move by the Reserve Bank of India, and we welcome entrants like Bandhan Bank, they will both broaden and deepen the market. Having said that, I must add a word of caution over here. There is a lot of chatter going about that banks will not exist, or the digital banks will come in and all that. First of all, it is entirely correct that branch banking will have a lesser impact. For example, in our bank, we have substantially started the pace of growth of branches has decreased. We are putting in efforts like e-lobby, number of ATMs, cash recyclers, passbook printing machine, express lobbies, the alternate delivery channels are taking over, firstly. Secondly, we have seen that mobile banking transactions are growing exponentially. So the nature in which banking is done is definitely changing, will gather pace and momentum, and will change further in the future. Whether banks will disappear, not at all. I think it's rubbish to say that, because essentially banks are very highly managed and a very highly regulated entities. And the Reserve Bank is very, very careful to whom it gives licenses. The deposits of millions and millions of depositors are involved. Therefore, banks as an entity are certainly not going to vanish. What is certainly going to happen is that the way in which they function are going to change. I doubt if suddenly some jolly digital banking is going to come, or other players are going to come and take over, because banks themselves, as they exist today, are changing. They are very savvy, they are techno-savvy, they are changing with the times, and I think they will evolve to face whatever challenges the future may have to offer. The second question, it's a related question, is that currencies such as bitcoins would come up. Please understand that they would have niche uses, but essentially a currency must have a lender of the last resort. The Bitcoin does not have any backing from any source whatsoever. So, and that is the essential. There must be a lender of the last resort. Therefore, we see that lots of alternative currencies come in, rubbish. Let me categorically say that. And yes, there would be certain alternative, you enter let us say a food court. You deposit currency, they give you a card, and you can use it any. So there would be niche areas, and again, these are very welcome developments. But I don't think that banks are going to disappear anytime soon, whether here or anywhere else in the world.
So, Mr. Ghosh, how much of a competition are you going to give in the digital space to the already existing banks? You and IDFC put together, you have an advantage over the others because you can have new systems and processes in place which are new age technology. Is that going to be a big competition? The existing banks say there isn't going to be enough.
Till now, we are not looking anything as a competition on that, because we are maximum, our customer already open the account with us, and they are from unbanked area. And it is 83 lakhs customer and 15 million accounts, we already been got it. And they are regularly transacting us. The main issue is they are not opening the account and give the banking service only in the bank premises. This is the issue is there how regularly I knocked the customer to use this channel to deposit their money and take as a loan. So we have the one advantage on that. There is a 2,68,000 spot, which every week we are meet to our this 83 lakhs customer. So that it is when we are knocking to the door and they are happy to give 10 rupees, 50 rupees, 100 rupees, 1,000 rupees. They are happy. They are not like to come to the bank branch. So that this advantage is our side. So whoever now is an existing bank and traditional bank, I know that they have not that network to knock that customer on that.
Right.
So that we are like to take one advantage. Second advantage is their payment bank issue on that. It is calling and talking with the mobile and using the money with mobile is totally different. Finance is a trust. So when I talking with you with the mobile phone, so I am not thinking any risk matter on that. Maybe my one missed call will be happened on that. My account will be deducted as a 1 rupee or 5 rupees. But when I deposit the money to the mobile, so it should be need to the more create the trust. And in that sense is need to the large number of people should be educated how they use it. Until they are not educated to use it, they cannot feel the comfort and not get the trust, and money will not come that channel. So that is also big issue is there.
Right, but one more thing that is being talked about from the payments bank space is that 1 lakh deposit may also give higher returns to the depositors, and that could pose competition for the banking system. But we'll discuss that at length at some other forum.
This is debate also.
But that is a debate in itself. But Mr. Kumar, I want you to jump in on this. One part of digitization and new age technology is acquisition of customers, keeping the customers. A large part of that can be replicated over time by the entire banking system. The other bit is the analytics, which Mr. Srinivasan rightly pointed out, and also detecting where the risk is coming. Now, I know when I last met you, you were heading SBI CAPS, and the largest amount of transactions and the deals have happened in the highly debt-laden companies in the last 2 years. And you have been spearheading that one. So in your view, where have we gone wrong with such huge amount of NPAs trickling in? And can that be addressed by the new technology?
Right. So now when it comes to the lending and using the models, what you have to realize is that when the loan value is less and the number of clients is large, there the models would work better. And you would have seen many banks are advertising that we can give decision in 1 minute, 2 minutes. So all that decision is flowing from use of data analytics. And for State Bank of India, we're sitting on the largest database. And we are working in a very focused manner on developing our models, risk models, but that would be more on the personal loans, smaller loans, car loans, agriculture, SME. But when it comes to the corporate lending, there are risk models which we use, but as the loan size increases, the judgmental factors, human factors, they become more and more prominent. So you can't use the same model there. So in mass banking, yes, data analytics and risk modeling will play a greater role. As far as corporate banking is concerned, I don't think so that the risk models can be that much relevant. Now, coming to your question on NPA, where did the banks go wrong? If you look at the history of NPAs, particularly public sector banks, as comes out in media, are always at the receiving end as if the bankers don't know their job. So, but I don't think that's the...
No banking discussion is complete without the NPA discussion.
We had in public sector banking system in 2001, NPAs as high as 13%, right? Then there was a period from 2004 to 2010 where the NPAs went down to 2%. And believe me, it is the same people, maybe in different capacity. Maybe Mr. Srinivas, myself, Mr. Dhawan, all were there in corporate banking, but maybe at a lower level. So to say that it is, but if I say that there is no scope for any improvement in internal processes of the bank, that would also be not a correct statement to make. So a lot of work needs to be done as far as the banks are concerned in terms of most of the problems lies in their due diligence at the pre-sanction stage itself. Large projects, probably we have learned a lesson very hard way that a lot of skills are required. Suddenly there was a demise of development financial institutions like IDBI and ICICI, and the onus felt on the public sector banks to fund the infrastructure growth, and probably the kind of skills which were needed were not available. So that is definitely one thing, but I still believe that apart from the internal factors, it is the macroeconomic environment that has also played I would say, havoc on the banking system in terms of stress asset. And coming to the channel strategy, because a lot of discussions on the channel strategy about the relevance of the branch banking. So each bank will have to think of their channel strategy. And maybe the branch banking, you need to weed out the small value transaction, but for value added services, for client advisory, for giving loans and this thing, I think branch banking will still be needed. And what is the cost of transaction and which channel to use? That is very, very important. And when banks look at their strategy, it should not be looking at that how many branches I am open. It has to be an integrated strategy that going forward in next 5 years, what would be my branch network? How much customers will transact on mobile banking? How many ATMs I need to book? How many I need to move on? Internet banking, so like that. But as the alternate channels, they develop, the role of cash in the economy is going to go down. But all the banks which are coming in, one thing is still in rural psyche, and I have worked in a circle like Northeast, is still, believe me, that's like going forward it may change. But today the Sarkari bank is a state bank. That is the only Sarkari bank that is considered to be, safe. So when people put their money, their deposit, safety comes to their mind. So it will be a lot of hard work, even for the new banks, to gain that trust. So that will be a very material factor. But yes, the ease of doing business, services at the doorstep, how do we handle small value transactions? So yes, even today, like as I said that I worked in the Northeast, and people have to travel maybe 10 kilometers, 12 kilometers for doing their banking transaction. That must change, and that can change like in, say, for example, in a village, if you just, the grocer, if it is a banking correspondent for me, and I have a POS machine there, and he can dispense 2,000 rupees cash at any time, and this thing, so I can tackle that problem. And many banks are now joining hand with telecom companies and this thing. So there will be a space where you will have to partner with maybe telecom companies or this thing to handle this low value and high volume transactions. And still the branch banking will be relevant for value added services. And that's how your strategy should be.
Of course, government has also done the Jan Dhan Yojana, which is increasing the pie at least, or at least financial
already like
inclusion.
public sector banks, they have captured a huge chunk of it.
Yes,
So it is the bottom of the pyramid, and as the economy grows, I don't think the customer is always lazy. That is what you have to believe. So they don't change the bank account so easily.
That's right.
So if we have already captured that space, I think 80% accounts have come to the public sector banks. So for any bank to take away those accounts is not going to be easy. And it is not that we are just going to competition, let them come in and just take away my customers. I have spent a lot of money in investing technology. I have spent a lot of money in acquiring those customers. So it's not going to be so easy. Let me warn all the...
But Mr. Kumar, telecom players were also as comfortable as you are till mobile number portability happened. But I'm just saying that competition
we should not be in
there.
false comfort. That's what I'm saying. We should not live in false comfort, but we are aware of the customer, and there's a strategy to meet the competition head on. That's all what I'm saying.
But I choose to pick one point that you mentioned, the infrastructure funding side. And Mr. Nair, you're the best person on this panel to talk more about this. Infrastructure funding, the NPA situation, and where it is headed.
I think all of us know where it is headed. I mean, what is the situation now? I won't be able to say where it is headed, but that depends on what measures we take. First of all, let me say that, infrastructure financing in India has been primarily funded by banks. I agree with Rajneesh because, the public sector banks had no option also and given the primary responsibility of funding this. And, probably if you are not stepped into infrastructure financing, let us say power sector, none of us will be sitting in an AC room today. So you can't entirely, a lot of times, I'm saying this because many times questions are asked, why did you people lend to infrastructure at all? I mean, in hindsight, you can always ask the question, but we must understand the priorities given